Good afternoon and welcome to the June USDA crop report webinar, I guess we call it. And we're going to take a look at today's crop report. First of all, of course, we want to always make sure that we get the disclaimer slide up and give you a chance to read and memorize that. And those of you in the industry will certainly appreciate that. We're going to talk about to open up today, we're going to talk about, again, what is the background money flow situation behind this crop report, because I think that's had a significant impact on the weather rally we've had this week. Then we'll talk about the crop report itself, the numbers that were in it, and then start breaking down the fundamentals, looking at the weather, since weather is a big factor. We have some new information that's come out here within the last 24 hours regarding the July outlook that I want to share with you. And close out with what our projections are going forward for the supply and demand balance sheet and what some possible scenarios are, and then close it out with some questions. So be sure to, as you think of your questions, to input them in the opportunity there on the screen in front of you. And at the end of the presentation, Jake will provide those questions to me. So for the time being, let's go ahead and get started. And of course, this is no new slide for those of you who are regularly on the webinar. Price is still a function of supply and demand that is modified by the flow of money. And that really has a big impact on the markets. We've shown through some previous presentations the impact that it does have on final prices for corn, soybeans, and wheat. And so we want to look at what is the context in which this crop report comes. First of all, the dollar, and this is a weekly chart you're looking at here, of course, we're particularly looking at what's been happening here in 2017. This is, here again, each one of these bars is 1 week. And after hitting our high, our peak, 13-year highs in the dollar index on the first trading day of January, I believe it was, we've been trending lower ever since, and this trend is still in place. Now, we bounced the last couple of days. Particularly today, we were bouncing once again, mostly due to weakness in the euro. Oops, go back. Okay, but we're still in this broader channel. You see here on the right-hand side, trending lower. Will we go all the way down to this longer-term level of support? That is yet to be determined. We could bounce here at any point. You can see here I didn't measure it, but we've essentially, it looks like we're maybe a little bit past the 50% retracement level. I guess if you go all the way down to this point, measuring up to there, we're probably getting close to that 50% retracement level. So we're going to watch this dollar here carefully, but right now it's still in that downtrend, and whenever it gets to the bottom, then it bounces back up toward the top, and then it sells off down, makes new lows. So we're watching this very carefully. Long term, that's because whenever the dollar is moving higher, we tend to see money come out of the commodity complex. When the dollar is going lower, we tend to see money go into the commodity complex. That's the historical pattern. Really, since much of 2017, they've been trading together, and that's an unusual pattern for them to trade. I'm anticipating that we're going to go back toward a more historical pattern at some point, but when is the question that's still to be determined. So we're keeping our eye on it. Now, here again, we look at the CRB index, the Thomson Reuters CRB index, and you see that we've basically been going sideways here, well, really for much of almost the last year. Here again, this is a weekly chart. We're pressing the bottom side of that. Thus far, we essentially bounced right off of the bottom of that this week. So we're watching to see if we bounce back up. Now, the previous bounce went lower than the bounce before it, and the bounce before it, so we are in a little bit of a downtrend here. So will we take a bounce, or will we break through the bottom? And one of the keys to that is going to be crude oil, because as you can see, crude oil has, well, where is it? 23% of the CRB index is made up of crude oil. Overall, the energy sector, which is very tied to crude oil, makes up about 39%. So energy sector is a big influencer on this. Right now, crude oil did bounce a little bit today, but overall, it's been very bearish of late with the focus on supply. We came out of the OPEC meeting where they extended the agreement for 9 months. They offered nothing new to the hedge fund managers. OPEC thought that they had really worked the hedge fund managers and gave them the rhetoric that they wanted to hear. They had numerous meetings, it's reported, with hedge fund managers. They thought they had this down, that they would extend it, they wouldn't have to deepen the cuts. They gave nothing beyond expectations, and you got to feed a bull every day. Nothing new. They built these expectations and provided nothing new, and so the hedge funds started to sell off. This is a real concern. Now, like I said, of this commodity group of commodities which are in here, of the food items, the energy items, the metals, and et cetera, it's heavily weighted toward energy. So now we look at the continuous commodity index, which is equally weighted among all those commodities, and much different picture here of late. It has already broken through that lower level of support, so it looks more bearish than is the CRB, and that's despite the recent rally that we've seen in corn, soybeans, and wheat, which are part of both of these commodity indices. So that says that overall the funds remain very bearish, the commodity sector. And I will argue, and I think the data supports it, that we've had a pretty weak, considering the large, massive short positions by the hedge funds built in the grain complex in recent weeks and months. This has been a pretty weak weather rally so far. And I think it's largely because, and I think this illustrates my point very well, when the funds are bearish the commodity sector, they look at the same fundamentals for the grains differently than when they're bullish the commodity sector. If they were to suddenly turn bullish the commodity sector, and there's several things that could cause that, like a break lower in the stock market, for one thing, could do that, or a really sharp sell-off in the dollar, unless it was something that made the funds worry about economic collapse and demand for for commodities. Factors like that, perhaps. But if we were to suddenly turn sentiment more bullish toward the commodity sector, then I think they'd look at the same weather scare, I'll call it at this point, and we'll go deeper into that later. And we'd be seeing much stronger buying, I think, and much stronger price rise. Of course, farmer selling is muting some of it, but if you get the funds bullish the commodity sector, they can really override that farmer selling pretty easy if they throw their whole weight to buying behind it. And they really haven't. We've seen some fresh buying come in by some of those funds who follow weather factors, weather fundamentals, I'm going to say, like in soil moisture content and temperatures, et cetera, in making their decisions. But I think the short covering has been less than what people think. We'll see when the CFTC report comes out, but keep in mind today's CFTC report is data as of Tuesday. So we'll really have to wait till next Friday to see what's happened the rest of this week. Regardless, when we look at the relationship here between the CRB index, which is the orange line, I can't bring myself to say burnt orange, but the orange line, the shaded area being net fund ownership of corn, soybeans, and wheat. You can see the relationship, 0.74 correlation. We see, you see right up here in the upper right-hand corner, 0.74. Anything above 0.7 we see as a strong relationship between these. So overall, as money is going out of the commodity sector at large, and specifically the CRB, that does have an impact. Now, as I said, the CRB is at major support level. If it bounces off of that, and crude oil would have to be a big component of that, you would think, and rallies back up to the top of that trading range, then that money flow would turn more positive, and it could be timely for fueling this weather rally a little bit further. So that's what I'm watching over the next week to see if we bounce off and actually create a rally, or whether we break through that support. Now, looking at the numbers here, first of all, we'll start with South American production. No real surprise in Argentina. Maybe the soybean crop is a little bit bigger than trade expected. A corn crop a little bit smaller. No real surprise there. Not far from what we were anticipating. As you look at the Brazil corn numbers, the corn numbers coming in a little bit bigger than what the trade expected, still a little bit smaller than what our team in Brazil anticipates. Soybeans, though, came in above the top trade guess. So that was a little bit more of a surprise. We had, our team in Brazil had the largest estimate in the trade survey. This is the Reuters survey. And we had the largest estimate, and it topped ours. So big crop, and that's another reason why USDA didn't change the export numbers in today's report. We'll talk a little bit more about that. Winter wheat production, the trade was expecting it to go down, and instead it went up slightly, about 4 million bushels. Surprised to see Kansas go up a little bit more. It's our thinking based on the harvest results we're hearing from the Southern Plains, and this may be our highest number we see. This also does not have, as you see, the hard red spring wheat crop estimate in it, and we're anticipating that to be much smaller. We're hearing reports in the Northern Plains of some hard red spring wheat 7 to 10 inches tall and heading. That's not good. So we'll see what USDA says in their next report. U.S. ending stocks, 924 million for USDA for wheat, 2.11 billion for corn, 495 million for soybeans. Now, we're anticipating that the corn and the wheat numbers and the soybean numbers will all make their way lower, not necessarily to levels that are bullish, but at least heading in the right direction if you're a producer. Global ending stocks, I think the trade was a little bit surprised that wheat went up, certainly higher than what we anticipated, higher than what the trade anticipated. Corn went down a little bit, not materially so. We're expecting that to maybe go up a little bit as we go forward and fully get in some of the Brazilian crop and some other areas, but we're not really that far off as a percentage, pretty close there. Soybeans, I think, was a little bit more bearish than anticipated, 92.2 million metric tons, and that was because of the larger than expected crop that we saw in Brazil largely. Now, we did a Twitter survey over the last 10 days or so, and here are the results from that. And I just kind of asked, with the help of Jake and our marketing department, developing the survey, really some expectations of where we're going to see acreage go relative to the USDA's March 31 report. And you see at the top there the results from the soybean survey, right below it corn, and to its right then is grain sorghum, really kind of confirming the expectations that, excuse me, confirming those expectations that when we get the June 30th report, that we could see the corn and grain sorghum numbers ratchet down a little bit, with soybeans ratcheting up. How much, I think, is yet to be determined. Corn is closer to being determined, but soybeans not so much. Now, USDA came out with just slightly below 90 million acres of corn on March 31. Our survey came in after that when corn prices are rising and showed a higher number, I think 91.6. Our recent survey pulled that down a little bit as expected. Now we're down to 90.6. So the question is, did the number go up after USDA survey and then back down, or is it just going down from the March 1 survey number? And we're still trying to get some more data in on that. But the bottom line is, at this point, still trying to get more data in, but a drop below 89.5 million acres is still a little bit of a stretch. Some would argue maybe we're down to 89 million acres. I'm not ready to go there yet. On soybeans, similarly, our numbers were showing after USDA had the March 1 survey data released on March 31, our survey came later and showed that the numbers had actually came down because of the price spread narrowing between corn and soybeans, less of an advantage for soybeans. But as that has continued to happen, have we dropped soybeans more? I mean, the new crop soybean corn price ratio down closer to 2.3 than 2.7 and it was earlier this winter and spring, how much of an impact that's had. Right now, I'm not ready to take soybeans up that much. We'll take a look at that here in a little bit. As we look at today's crop report numbers, corn stocks are still quite adequate, certainly not as burdensome as what they were in the mid-'80s. It wouldn't take much of a drop in yield this year, as we'll look at here in a little bit, to get us in a tight situation. But as of right now, we're not there. The trade is trading that possibility with hot, dry weather currently in the northern plains and western Midwest, but it's also expected to moderate over the next several days, and even starting today, seeing some showers start to develop in the area. So how long will this overall pattern hold? And we'll talk a little bit more about that as we go deeper into this webinar, and what are the implications for going forward in February. This heat event that we're in the middle of now, triple-digit heat in Des Moines, I believe first time, according to our Des Moines office, since 2012. I'd invite them down here into the Central Plains and experience a little bit of warmth if they're missing out on that. But overall, I'm sure our Des Moines viewers will appreciate that, our Des Moines office. But overall, it is a hot spell. And if you look back the last 145 years worth of data, weather data, we've only had a heat spell of this magnitude in the first half of June 7 other times out of that 145 years. So it's pretty significant. So Commodity Weather Group went back and looked and said, what kind of July weather did we have in those years that we had that kind of heat spell? It was a really mixed bag. There was very low correlation. There were some years that were hot and dry in July in the Midwest, some years that were cool and wet, some years in between. And in the hot, dry years, there seemed to be other weather factors at play that aren't at play this year. So we'll go into their overall forecast here a little bit later, but I did want to mention that. So, but the bottom line is on this chart, we see it wouldn't take much to drop us down to rationing levels, or levels that require rationing with higher prices, but we're not there. And so as long as the funds are bearish the commodity sector, they're probably not going to be interested in doing too much rationing of corn demand at this point. If that changes again, as I said, then we could be looking at different dynamics. If you look at where the bulk of the corn supply, surplus supplies are, they've been in China, who's basically not really a big factor in the world trade right now, and in the United States, and soon to be in Brazil. But this chart shows us in the blue bars that when we look at overall supplies of wheat in the world, we're looking at, let's see if I can do this, we're looking at about a 67-day supply. If you take the U.S. and China out of it, then you're looking at about a 42-day supply. And from a historical standpoint, that's pretty close to the 40-day supply we had back in 2012. So taking the United States and China out of the picture, we're pretty much hand to mouth. Now, I say that here again ahead of the big Brazilian crop. Even though, well, wait a minute now, the Brazilian crop would be in this because, look, this is USDA data, and they have their production estimate up there pretty close to our level. So that's even with the Brazilian crop in there. So that puts a lot of pressure on us to have a good crop this year. Commodity Weather Group and some other forecasters as well think that we will. Now, soybeans, I want to show this graphic again to show the parabolic growth that we're seeing in Chinese demand for soybeans. As we're still looking for that to come forward. Every year when I show this graphic, at this time of year, that last line there doesn't come up to the parabolic trend line. But by the time when we get to the end of the marketing year, it's usually up there. The exception was 2001, 2002, and 2008, 2009, when we had a short crop and the supply simply wasn't there for them to buy. So I'm anticipating that demand to go up to get there. I know that with the consolidation of hog production there, some of the pollution rules that they have, it's made it tougher for them to expand. But keep in mind, the amount of protein in the ration is still well below our standards. And so we're anticipating that continued growth of protein in there because they need to grow pork. Pork is the #1 driver of food inflation in China, and food inflation is one of the top concerns of Chinese government officials. They want to do everything they can to facilitate that production of pork. Excuse me. Okay, as we look at today's export, USDA did not change any of the balance sheet for soybeans for a new crop. But if you look at the history of USDA, you can see that they tend to understate its export target this time of year, because as I showed in that last slide, they start low on Chinese demand and then have to keep ratcheting up, and more of it tends to come from the U.S. than what they anticipate at this point, recognizing it's a new marketing year, doesn't even start till September 1. So particularly in recent years, over the past, 8, 9, 10 years, other than the 2 years that we saw in there, which was, 11, 12, 12, 13, we have seen that export target rise and rise significantly beyond this point. And then the impact on ending stocks is USDA is very good at overstating soybean ending stocks for the new crop balance sheet this time of year. And so they tend to work their way lower to the tune in the years that they work lower, the average is, I think, around 140 million bushels lower. So 495 today, that would be 355 million bushels. Not running out of soybeans by any means. It'd be less bearish, but I wouldn't call it bullish unless the funds would change their attitude toward the commodity sector at large. And particularly with soybeans, we can see those years when they do that, you can get abnormally large rallies in the soybean complex that really don't seem to be justified by the fundamentals, going higher than what you would otherwise expect. So that's one of the factors to watch it. So that brings us down to the weather. Will there be a prolonged weather threat for this crop going forward that would draw down those stocks to justify pulling or the funds covering their big short positions and adding more length and giving us a run up in market? Keep in mind that soybeans, most farmers have sold most of their supplies already. So that weight is on it. Brazil farmers have not. So Brazilian farmers could sell into such a rally, yet they are worried about their currency dropping further, so they're holding on to the hard assets, particularly soybeans that are priced in U.S. dollars. They're selling corn for the most part and holding on to soybeans. As we look at, and this is the latest projection that we have up here in the upper left, showing what the compilation of models predict from this point forward. If you go in the middle of range of these models, it suggests that we're going to hang around a very weak El Nino phase. That would be around 0.5 degrees Celsius above normal sea surface temperatures in the central equatorial Pacific. Some models higher than that, some lower than that, but a weak El Nino. And you see those probabilities played out here, particularly watching this June-July period, putting about 57% odds of an El Nino, not overly strong. Odds of a La Nina are extremely weak. Odds of a neutral type, a neutral warm phase, shall we say, better than 40%. So in those years, when you do not have a strong ENSO cycle, meaning El Nino or La Nina, then there are other factors that we also watch, and that would be this pool here in the northern Pacific, particularly in the Gulf of Alaska, that influences the storm track coming in the United States. This right here is where we watch for El Nino or La Nina, but more specifically is this area off the Baja of California. Notice this big expanse of warm water we've seen. Now, when it's warm off the Baja of California under these conditions, these ENSO cycle conditions, we tend to have mild, wet summers in the Midwest. We had a weather pattern here last month that was digging a low pressure into this area, upper atmosphere low pressure, and was providing a lot of rain and cooling these waters. But as I'm going to show you here in a little bit, they've been warming back up once again after that pattern change. And so we still think that we're in an area where we're going to see expansive warmth in that area. The other factors that play this year is a very strong jet stream expected to continue to be a factor. Now in '88 and in 2012, we also had a fairly strong jet, but it had more buckling to it because of more variability in sea surface temperatures that we had here in the Pacific. And so we're expecting a little bit more of a southerly track and not as much chance for high pressure ridge to develop this year. Now, Commodity Weather Group went back to 1950, looked at all the different years that had similar, no one year fits, but they looked at all the similar years as far as the weather pattern. And they found that 26% of them tended to be hot and dry. 16% warm and wet. 10% dry and cool. 48% cool and wet. Now, if you add up the odds for these three, you find, in which all tended to have above trend yields, you find that basically 74% odds of above trend yields or some type of favorable growing weather conditions, because even where it's dry, it tended to be mild. I'm reminded of the movie line, he said, where the actor was told, your chances are 1 in a million, and his response was, so you're saying there's a chance? Yeah, there's a chance here. It's better than 1 in a million. In fact, it's 26%. So if you had 100 years with this type of conditions as setup like we have this year, 26 of them would actually be hot and dry. If you have 50 years like this, 13 of them would be hot and dry. So this could be one of those years, and that's what the markets are reacting to right now. But if you're a producer and looking out there, I wouldn't want to bet the equity in my farm that this is going to be one of those years. I wouldn't go to Vegas and bet the house, so to speak, this is going to be one of those years. And so you want to maintain some flexibility in your marketing just in case this tends to be one of those, turns out to be one of those years. But generally building your marketing plan, your risk management plan around the expectation that the odds suggest that it will not be one of those years. So I wanted to show you that graphic to give you some perspective. Couple of the extremes that we could look at that we could see unfold here. First of all, if you have a stronger jet stream even yet like what we had in 1993, we could end up having that type of a heavy rainfall pattern in central and northwestern parts of the Midwest like we had in 93. That is not expected, nor is it playing out thus far, even though we've had some very heavy rains in southern and eastern parts of the Midwest. We're still not looking at a 1993 at this point, but it's one of the things we're watching. Or the other way is if the waters off the Baja of California do cool, that we could turn hot and dry in the Midwest, but so far that's not happening. Now, earlier this week, the funds got some support for their weather market when the Euro weeklies came out, and specifically now I want to focus on this set of graphics in the upper left-hand quadrant of this slide. And basically this is the July anomaly that the weekly suggested for rainfall, and then below it temperatures. The change from the previous month's release here is much drier, and it is hotter, more intensity, concentration of the heat focused in the northern plains, but stretching across much of the Midwest. That is concerning, particularly when you're in the middle of a heat spell that's kind of been matched only 7 times the last 145 years. Let's put a little bit of perspective on it. The same Euro weeklies last year released this forecast for the month of August, which in about the same time frame as what we are away from July, a very dry Midwest and very hot Midwest. This is what we ended up with, almost the opposite, with good rains. We were warm in the eastern Midwest, but we also had a lot of rain there. Nighttime temperatures were high, and we had, as you recall, yield over 174 bushels per acre for corn, a big 52.1, I think it was, soybean yield, record high. So just because Euro weeklies call for it doesn't give us confidence it's necessarily going to happen. This bottom set of graphics goes back to that period, that area off the coast of the Baja of California. And first of all, here we see the anomaly. You see how warm that water is. This is the change over the last 30 days for that area. This is a change just in the last 14 days. So more concentration at warmth in the last 14 days. Now, I thought I had another graphic in here. But basically, when Commodity Weather Group looked at the data of the years that we had this kind of warmth, etc., they found 2 other years where we were hot and dry in the Midwest despite the warmth off the Baja of California. And suddenly those 2 years escaped me. I knew I would remember them, and I didn't, and I apologize for that. One of them was a year notably known for it. I think it was 1983 for being hot and dry. But I believe that was a year we were in a La Nina weather pattern instead of an El Nino. The other year, it was in the last 15 years, and I can't remember which year now, it had actually been very cool early in the season off the Baja of California, and then it warmed up during the season. So it could be that that hot, dry pattern got locked in over the Midwest before that area off the Baja of California really got able to have an influence. So the data, the past history, we can't say with absolute positivity that we're going to have a favorable growing season in the Midwest. We can say that most of the years involved in the study that Commodity Weather Group did had good years. And so while we're seeing some stress now, we really don't see any type of substantial evidence to say that that's going to mean problems down the road. In fact, it's just the opposite. Now, if we look at pollination, we are looking at, this is showing from Commodity Weather Group where they forecast based on heating degree days to this point and heating degree days forecast in the weeks ahead. In the south, we're going to be ahead of normal probably because we've had enough warm, a little less so in the Midwest, obviously. But basically what this shows is this is the zone which covers the bulk, the core of the Midwest, where we should reach the 50% pollinated level between July 10 and July 20. So here over the next week or two, the 30-day outlook is going to start looking into that time period. Right now, it's still looking favorable. So I would say that the biggest concern while we're looking at this is the heat and dryness has been focused in here, but the heat spreading, and it's spreading into much of the rest of the Midwest, but most focused here. If you look at the 15-day outlook, basically South Dakota, Nebraska, and western Iowa are expected to stay pretty dry during that period of time. But then as we get into the 16 to 30-day, we get pretty much normal to above normal rainfall in the forecast for virtually all of that area. So it has to hang on until that point. And I know some of it doesn't have the root system, is going to be a challenge, but that's what traders are looking at. This outlook is not significantly changed from last month when I presented. I'm still looking at, if you use 170 bushel yield, which is slightly below where USDA is at. I think my model right now is at 169. If you use USDA's acreage, it comes out to a little over 2 billion bushels. Nothing to get too excited about. It's not bearish. It's not bullish. Nothing to get excited about. If we repeat last year's yield, and we do have a little bit more acres in here because we went up and then fell back a little bit more, like I was explaining earlier in the webinar, we could actually end up with something closer to 2.5 billion bushels. And so that would suggest a marketing year average cash price a little bit lower, around 3.25. If on the other hand, we do lose 1 million acres and we just pull yields back about 5 bushel, excuse me, that pulls ending stocks, excuse me, projections down to 1.562 billion. That still seems adequate, right? But when you start putting in the price regressions, looking at marketing year average cash price, not futures price, but cash price, suggests a cash price of $4.30 for the average for the year on farm. So that does give us tight enough stocks to use ratio that we would anticipate that the funds would come in and start running things up a little bit more with this weather market. So that's why it's worthy of paying attention, worthy of watching, but the risks are high as well. As we look at soybeans, we're looking at 487 million. This is our estimate before the USDA report today came out at 495. Excuse me. Marketing your average cash price of 910. If, on the other hand, we repeat last year's yield and we add another 1 million acres, which some are saying that we could do. I'm a little bit skeptical, but I wanted to include this possibility in here. Ending stocks go over 850 million bushels, marketing your average cash price at 835. We probably have a harvest low in futures below $9 in this type of scenario at some point. If you drop acres a little bit, 1.5 million, which still could happen. It's not expected, but I could see it happening, and we could build that scenario. And you drop the trend yield 5% due to adverse weather. If it does turn out to be hotter and drier than expected, then that suggests 274 million bushels ending stocks and marketing your average price at 10.55. Certainly that would be, what, $2.20 higher than the bearish scenario here, and about $1.45 higher than the anticipated. So there is some possibilities of volatility there. Looking at wheat real quickly here, hang on with me, corn and soybean people, for our question and answer session. Basically, we've got a lot of stocks in the world, well over, what is this, over a 4-month supply of world wheat stocks. But if you remove China and the United States, then it's a more reasonable, closer to 70-day supply. Excuse me. As we look at the winter wheat conditions for this past week, we see a condition index score of around 337, I believe it was. See where that's relatively good. If you look over the past 10 years, it's over the 10-year average. You can see here the blue line is the final yield for winter wheat. Down below, I have spring wheat, and for spring wheat, this condition index score is one of the lowest on record. The only one lower was back in 1988. And then that final yield, of course, USDA is not projected to yield for this year yet. Overall, this is the USDA's winter wheat yield, pretty close to their trend level. We're expecting that to drop somewhat as we get into the next report. This report, we basically saw the areas that have been hot and dry, saw the winter wheat yields drop. A little bit surprised to see Kansas go up a couple bushels in this report. And that's the big question mark as we get into central Kansas, where we believe the yields are going to be very good. How does that weigh out against the western third of the state, where we've got a lot of problems, where the winter storm was, wheat streak mosaic, etc. Excuse me, see if I can hold on to my voice here to finish. And overall, we find that USDA raised the yield a tenth of a bushel because of some pretty high head weights, very high head weights. Heads per square foot, pretty low compared to where we've been in recent years, but very heavy, very large heads. And so that's how they came up with the yield that they did. Excuse me. If we look at this by class, I want to say, first of all, that the 2017-18 bars on each of these are my projections, not USDA's, because USDA has not released a broken down balance sheet for 2017-18 yet. It's waiting for its spring wheat production estimates. This is what I'm anticipating: a significant decline of hard red winter wheat stocks, but still almost a 5-month supply. More significant, much more significant drop in hard red spring. That's why we're having the price rationing. It's basically we're tight on protein in the world, and the mills are getting very aggressive now in trying to buy whatever protein they can because they're panicked about it with what's been happening in northern plains, southern Canadian prairies. Soft red winter wheat is the problem overall. If we look at the balance sheet, here again, USDA projecting ending stocks at 924 million bushels for new crop. I'm at 855 million. We'll learn a lot more in July, see what USDA does with the spring wheat. Bottom line, and get your questions ready because shortly we're going to be taking those questions. Jake will be reading them to me, so go ahead and start writing them in there in the form provided on your screen. Today's report was basically void of any surprises significant enough to change the sentiment. The sentiment is bearish toward the commodity sector at large, but we're in a weather market, a seasonal weather market. So the question is, how far will we run? That'll depend on how far this, I would say, adverse weather goes. Does it break next week? Does it extend into late June where it can do a little bit more damage? How long does it go? And fundamentally, it's difficult to be bullish soybeans without significant help from the weather. Corn and wheat have less margin for error, so we're watching those a little bit closer. I think Minneapolis wheat has clearly been the leader in this, and then corn has taken up some leadership role of late as well. Excuse me. Outside money flow is pivotal. Is at a pivotal point, as I showed you on those charts. Right now, markets do not stay stagnant. As a rule, the funds don't make money in a stagnant market. They're going to find a way to move it. Will it be up or down? Watch those major commodity indices, how they respond to testing at support level the last couple of days as we head into next week. Do they break through that support level? Do they head back up toward the top of the channel? That's going to be part of the key. And of course, the continuous commodity index has already broke through, but trying to consolidate now and trying to recover itself. So with that in mind, we're going to take questions. And so Jake, as the first question comes in, will go ahead and pass it along to me.
Hey, Arlan. Let's just give it a few seconds for some questions to come in.
Okay. There's a few of you out there who do a good job each month providing some questions, and we welcome that. If not, maybe I will hang on here a little bit longer. Perhaps I did an adequate job of explaining it and answering your questions. Pretty benign report overall. We're in a weather market. Hopefully I explained what the potential risks are with the weather as we go forward, and where those risks are at and what to watch for.
Hey, Arlan, we got our first question from Jesse. So where will sorghum acres end up?
That's one I've had more difficulty trying to get a handle on, because all of our surveys, we just have not, we've generally shown a decrease, and but we don't have the survey numbers to give us confidence in that. Some of the surveys showing us down at 5.5 million acres. I don't know that we're going to be that low. I think that's a pretty drastic, particularly since we're hearing, now I know in the Western Plains we're hearing about a lot of wheat being baled, and even some in the Northern Plains, and going to put a spring wheat crop in. You think, okay, Western Kansas, they're baling the wheat, they're going to put a spring wheat crop in, probably going to be grain sorghum, but the aphid is a tremendous problem out there for grain sorghum. And they're actually going in with dryland corn in that area. They basically have enough moisture in their profile, which is very unusual for the high plains, that if they just get one or two more rains at a timely point, they could have a decent corn crop in that area, dryland corn crop. So it's possible we could drop all the way down to 5.5 million. I'm still trying to pull some data in before I have to submit my estimate for June 30th, and I'm not quite ready to go there at this point.
Next question comes from Greg. Spring wheat June weather outlook. What are your thoughts?
Spring wheat June weather, some of it's already done the damage. As I said, 7 to 10 inches tall and heading. You're not going to recover a lot of yield potential on that with rains coming in now. And basically South Dakota looks to stay dry excuse me, for the next 15 days as well, and that's critical. South Dakota is further along in the maturity. So I think spring wheat has some real problems. And USDA's current total wheat production number is heavily propped up by expectations of a trend yield. And I think the final spring wheat yield could end up being 10 to 20% below trend. That's pretty significant. And if that's the case, then we probably have some significant tightening, because I'm also looking for an acreage reduction, particularly in harvested acreage, but I think planted acres June 30 and then harvested acres as well. And I have some of that built into my balance sheet already, which is why I have an 8 in front of my ending stocks number for wheat instead of a 9 like USDA does. But in some of my scenarios that I've painted, we could drop this whole wheat ending stocks level down to a 7 or even a 6 if we continue to have the stress. As we get into the 16 to 30-day period, though, the weather does improve significantly if today's outlook holds, with above normal rainfall in much of that area. So we got to see if that verifies. 16 to 30 days out is quite a ways out.
Next question comes from Bob. This USDA report does not project acres and yield for hard red spring for 2017-18. Where did you see these numbers?
Yeah, very similar to what we're just talking about. I'm trying to remember the numbers I have on my balance sheet. I think I pulled down to 40 bushel, which would be pulling it down about 10%. Still trying to pull in some numbers and looking at the ratings, but I could see that dropping up to another 10% yet into the mid-30s. So certainly I haven't done that yet. Certainly something we are watching. Going to watch and see how this weekend's rains play out.
Next question comes from John. Any thoughts on how Brazilian producers move corn or soybeans as they harvest the Safina crop?
The best indications we have from our conversations with our Brazil research team is that they want to sell corn and hold on to soybeans because of the currency risk. And there was more news from Brazil today as Reuters was reporting that federal police went into JBS Meatpacker and one of its affiliates to confiscate records on a possible insider trading investigation, is what is being reported. But all of this is tied also to the government. There was also some good news, though, that would indicate some of the investigation that's been carried on television live down there may end up clearing the current president of some of the latest charges. So the bottom line is whether the reforms that the current president are able to move forward for the economy, strengthening their currency, or whether their president gets pulled into the second impeachment in the last year of a president in Brazil, and the reforms lose their popularity, and then if they have a popular election versus an indirect election, indirect would be where the leadership picks the next president, a direct ballot would be where the people do. And if that's the case, there are a couple leaders that are very popular with the people who would totally unwind the reforms, and we could see a significant weakening of the currency. From right now, it's bouncing around between 3.25 and 3.3 reais per dollar. Some are saying it could go considerably lower than that. And so basically, whether it's trading 3.2 or 4, has a big impact on the price of grain there, particularly of soybeans. So as long as there's that risk of additional weakness, the farmer there would prefer to hang on to the hard asset rather than having the pesos in the bank that are losing, we're talking Brazil, the reais in the bank, pesos would be Argentina. So they'd rather hold on to the soybeans. Once they get a handle on that their currency weakness risk is passed, then we anticipate more heavy selling of soybeans whenever that may be, and that's hinging on those developments.
A follow-up question to that on Brazil. Can political turmoil in Brazil impact their ability to export?
Yeah, and I think it is already. Now, we have been selling periodic cargoes primarily through the Pacific Northwest to China because soybean basis has been holding firm enough in Brazil that we've remained competitive. If farmer selling were to really accelerate, then they would beat us on that basis and ours would shut off. we saw about 7.5 million bushels sold to unknown destinations today. In the last couple of weeks, unknown destinations has been a pretty significant buyer of old crop soybeans. The thinking is that that's China, and they're buying the soybeans in case the Brazilian farmer doesn't sell anymore, they can come to U.S. and get those beans. If he does all of a sudden dump and provide cheaper beans there, they can simply roll those purchases into the new crop year. So that's the thinking right now. The bias is, therefore, USDA is probably going to have to raise its old crop export estimate, lowering our ending stocks estimate, which gives lower beginning stocks for next year. So that really comes down to when do they get some type of stability in Brazil to where the farmer feels like the low is in the currency.
Next question comes from Andrew. Is this the highest we will see the USDA go as far as South American corn and soybean yields, or is there still time for yield to grow?
There's still time for it to be adjusted yet, adjusted upward as the bias big crops get bigger. They could go either way, but that would be the bias. But the trade is now going to assume that we basically know the size of the South American crop. So any other adjustments are not expected to be significant market factors at this point.
Jaime has a question. Arlan, we're coming out of the third straight record growing season in Latin America, about the same in North America. Are there any historic records of this happening? What would be the effect of not record-breaking crops on markets?
Well, demand is strong, and the demand is there. If we would get out of this trend of record crops, I think we could tighten up the supplies rather quickly and pull prices higher. The question is, when are we going to do that? We have had, and I can't speak for back-to-back North and South record crops on both sides of the hemisphere. Specifically, though, I can speak to North America and the United States. We have had times in history when we had, I think, back-to-back above-trend yields, I think 5 years in a row. So it's still possible that this could go on. Remember, that doesn't change the odds, just like if you're flipping a coin and you flip and you get 4 heads in a row, that doesn't change the odds of what the next flip is going to be. You still got a 50-50 chance of the next flip being heads or tails. So we can't make any real assumptions. There is some pattern, and I know weather does go in patterns, but there is some history to suggest that we could very easily have another above-trend yield year here in the United States this year, and maybe even next year yet.
Our last question comes from Greg. With the U.S. dollar dropping 240-plus basis points in the last 30 days, what is more important to focus on going forward, U.S. dollar or crude oil prices?
Right now it's crude oil, and that's a great question. It's one that I've wrestled a great deal with because historically, as I've talked about, the relationship has been to go in the opposite direction. So for right now, I'd say one of the big influencers is crude oil more so than the dollar, but I do expect that if the dollar keeps going lower, and particularly if it has some momentum behind it, that will speed up the point at which the funds say that commodities have value. So I'm watching the dollar, but my primary focus right now between those two is on crude oil and the speed at which the dollar trends lower. Of course, as I showed you, that channel would suggest the dollar might be bouncing back to the top of the channel near term. But that would be the order right now, crude oil followed by dollar. Okay, if that wraps it up, then we appreciate everybody being with us. This has been great. We've had great response, and I really enjoyed doing this. So we'll be back with you on June 30th. That's the big stocks and acreage report, and I expect that report, even though it has far less data, to have far bigger implications for the markets, and particularly the markets going forward. And, of course, by then, we'll know a lot more about July weather. So come back and join us at the same time on June 30th. We look forward to it. Thank you.